Hey, it's Mike Belfor, and there's something I really want to share and kind of go over. So there's a lot of questions about inflation, especially the last couple of years, concerning especially our monetary system, Federal Reserve. Candidly, I'm working on a book to help unpack just kind of the Federal Reserve, U.S. Treasury, and how things function with that. However, this presentation may be a little helpful. So without further ado, going to this first slide. So why inflation destroys debt. So Adam Smith had a quote, and it's from A to Z Quotes. The problem with fiat money is that it rewards the minority that can handle money, but fools the generation that has worked hard and saved money. So here's just kind of a couple of graphs and statistics here in regards to household wealth and distribution of household wealth by the U.S. income group, showing what the top 1% or higher um, look like in comparison to those of other groups. Now, the reason why I bring this up is on August 15th, 1971, President Nixon announced that there's going to be something called Nixon shock, is what we call it today. However, it was basically this statement saying, "I've directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold or other reserve assets," which essentially creates what we call a fiat currency. And essentially, prior to that, we're based off of the gold standard, is what we call it, right? So if you looked at an old dollar bill, you'd see it was based off of a commodity. If you looked at a dollar bill before 1970, let's say, and what this fiat money actually is government issued currency that's not by a physical commodity like gold or silver, but rather backed by the government that issued it. So this gives a comparison then of what things look like in 1971. New house, $25,000, but the average income was about 10,600 a year. A new car is about 3,500. Average rent to rent a place back then was about $150. Tuition to Harvard. I know there's been news lately in regards to tuition to Harvard, the cost thereof. Depending on income brackets. However, back then it was about 2,600 a year. Movie ticket was $1.50. Gasoline and of course U.S. postage stamps, and then going by food as well. As you know, we tend to measure or like to measure the consumer price index measure of that, or part of that is food, and a big number we look at is milk, right? So you can see kind of what milk or the cost per for a loaf of bread would cost in that as well. Now, this shows cumulative inflation from 1913 to 2022. Now, you can certainly see, through 1910 through the late 60s, inflationary figures were not as great when it comes to the dollar or our monetary system as it was from 1970 to where we are today in 2025. In fact, we see this giant spike. You can see kind of this curve just goes straight up, right? And if you want to kind of know why, we can look at the consumer price index inflation calculator. And I'm going to use, or what I used for this data was in 2024. And this can be found on the U.S. Bureau of Labor Statistics. You can play around with this if you're curious to even look at different figures like 1980, 1982, 1990, whatever. But the idea here is to look at January 1971, looking at $1 million, what that would convert um, to January of 2024, and that would be 7.749. So let's call it 7.7 million, right? Is how far $1 million of 1971's currency would go in today's market, right? So if you wanted to do the reverse of that, it of course is quite a bit less, as we see there. It's essentially showing the buying power of that money over time, due to how our currency is working as what they call a fiat currency. So that looks at something called real versus nominal value. So nominal value, a couple things about that, as you can see in this graph, is the prices we see every day in the supermarket. That could be the value of what we see in our bank account, value that we see in our pay slips, paychecks, right? And what we quote when we sell things informally. Now, real value is relative to some other points in time that is other than the present, right? The data is more useful when we're making comparisons and transforms normal value by taking account price level changes, like as we just saw, inflation or inflationary figures, right? So this gives kind of a measure. If we look at Standard & Poor's, so you look at the S&P 500 versus all money, and you could see kind of these spikes, and we can know these markets are volatile and these things happen. But this blue line here is a consistent number showing all money and how that continuously has improved over time. And we could see, of course, big wins with the S&P with that gray or green, pardon. So it does show, of course, we could see how this is outweighed currencies. Now, if you look at U.S. house prices, right? So all money. Keep in mind, money in dollars inflation. You see this inflationary figure. You see the dollar kind of going up because of the dollar's value, of course, right? So how far the dollar goes. If you look at a property, as we saw in 1971 versus where we are today versus U.S. house price, where that tends to be. And of course, we have U.S. house price in regards to gold as well. So you can see the difference between gold and U.S. house prices. And really, gold has had some major spikes after 2001, 2002, and so forth. We did want to show a graph here as well as it is relative to oil. And so this comes to this whole breakdown of what you could see when it comes to what is called inflation-induced debt destruction. This is from jasonhartman.com. But when you look at mortgage payments and 30 years of inflation, what inflationary figures do, and we look at that value of the property, as in this example in 1972, $18,267. The mortgage amount then 14,614, mortgage rate 7.375. It's a 30-year fixed, and the mortgage payment of, we'll say, $100. Loan value 80%, assumed tax rate 33% based off of irs.gov in that tax bracket. So if you see this annual inflation figure, you look at the year and you see the annual inflation, you see the dollar amount, really where that dollar was, right? The annual payments, right? 1210, let's say. And then you have annual payments adjusted for inflation, 1210. And then you have 856. What's interesting, however, if you get down to 2001 and we look at that, you could see how annual inflation over time, with these big spikes, of course, we had 80 and 81, whereas 13 and a half, 10.3, right? We did have a spike of inflation a little bit, 4.5, 5.4. Of course, recently we've had some, which I believe is not on this, so I apologize for that. But you could see how that affects things. And you can also see the nominal payments, as I just mentioned. This is nominal payment, right? But then you can see annual adjusted payments. So essentially, yes, but as this inflation number changes based off of inflationary figures and the value of that dollar, you can see how over time the actual monthly payment itself decreases significantly. And you can see in 2001, that payment in 1972, where are you? $285, right? In comparison to 1210. You also see annual after-tax inflation adjustment periods. And so you can get an idea, right? That's 282. So that's after tax using that assumed tax rate, if you will, 33%. So then you have your actual payments here. If you look at, just this course here of 20 years, 36,000, right, is the annual nominal payment. And then if you adjust that, $16,000 because of, again, the fiat currency that we're talking about. And then, of course, after tax, you have roughly $12,654. Now, again, we look at mortgage size, in regards to this, and this kind of breaks it down as us just going over that. But if you look at this final amount here, which is interesting, right? We just kind of went over all of those. The after-tax inflation adjusted interest rate is negative 1.16. Yes, the interest rate was 7.3. However, if you look at the actual dollar and the value of the dollar, as it carries over time, the actual dollar decreases in value, right? So those are things to really consider, I think, in this market as well. I mean, yes, home prices are quite a bit more expensive. However, folks tend to earn more, right? Things cost more. The dollar from 1971 has changed considerably. So those are some elements to think about, I think, when you're thinking about making a purchase or investment when it comes to real estate. Now, here's a graph again showing what this actually looks like. You can see how basically mortgage payments in 30 years of inflation. This data shows the average mortgage on an average house at an average rate with an average payment adjusting for inflation, as well as an after-tax conversion. So you can see exactly how this kind of comes down over time. So how's wealth divided in the US? Of course, we have the top 1%. Really is based off of, kind of all of these things, really, right? You have real estate, stocks, mutual funds, retirement accounts, private business, and other assets. However, keep in mind, real estate tends to be in each of these, and it tends to be what really is keeping folks in the higher wealth ranges when it comes to wealth, because it's a great way to hedge against inflation, fiat currency, the changes in things that we're seeing when it comes to the value of the US dollar and our currencies and inflation. So I hope this has been helpful for you. If you have any questions about any of this or like a copy of this, definitely let me know. Be happy to share it. Again, just want to thank you for taking the time to actually check this out, and truly hope you have a great day.